Okay, so we're now going to cover employee benefits, which is the second topic within our week 2 materials. So again, here are the learning objectives for you, which is a good, helpful resource to use when you are studying for your quizzes and final exam to make sure that you have been able to cover everything within this particular topic area. So this is a different accounting standard to the one we were looking at in the first part of the topic 2 materials. We're now looking at AASB 119. So when we are referring to employee benefits, we're referring to any form of consideration which is given by an entity to employees in exchange for services that they have provided. So employee benefits are a very significant component of companies' expenses, and every organisation has employees. So it's important that we understand some of the key aspects of accounting for these costs. Now, the accounting standard identifies 3 different categories of employee benefits. So it categorises them as short-term, long-term and post-employment. Our focus in our discussion today is going to be on some of the most common short-term benefits and long-term benefits. So we're not going to be focusing on post-employment benefits such as superannuation, for example, but we are going to be looking at things like salaries and wages, annual leave, sick leave, and long service leave. So let's start with the short-term benefits. Short-term benefits are benefits which are going to be paid within 12 months. The expense associated with these benefits and the corresponding liability for a future amount which is owing to the employee will be recognised as the employee provides the service to their employer. And the general rule is that these will give rise to an expense. For example, salaries and wages expense. So the general rule is that short-term employee benefits result in the recognition of an expense unless capitalisation is required under another accounting standard. So you can see here 2 exceptions to this general rule of recognising an expense. So as an example, if I am a factory manager and I am responsible for the manufacturing and production process, then my costs of my salaries and wages would be capitalised into the cost of inventory. So this is consistent with the absorption costing approach that you would have studied in previous studies on management accounting. Similarly, if I was a worker that was involved in installing some type of plant and equipment, then in that case, the cost of my salaries and wages would be capitalised into the cost of the property, plant and equipment, because these installation costs are costs which are required to get the asset into a state where it is ready for use. So for you, you are going to assume that the general rule of expensing something will apply unless a question specifically tells you to the contrary. The other side of the transaction will result in the recognition of a liability to the extent that the benefits have not yet been paid. So sometimes we could be crediting cash if we're making the payment straight away. Otherwise, it gives rise to a liability for a future payment that has to be made to the employees. Because short-term employee benefits are payable within 12 months, we recognise them at their nominal value. So they're not subject to discounting, but they're recognised as a liability at their nominal amount. So one of the most common types of short-term employee benefits are salaries and wages. Most employees get paid on a weekly or perhaps a fortnightly basis. And in many cases, the end of each weekly or fortnightly payroll period will not align exactly with the end of a reporting period. So some companies prepare their financial reports on a monthly basis, some maybe on a half yearly or annual basis. But if I think about an annual year end of 30th of June, it is unlikely that the employees would have been paid on that day. There will be some part of accrual that has to be made for unpaid wages for a couple of days, for example. So the accrual for those unpaid amounts, you can see the pro forma journal entry here. I recognise a debit to the salaries and wages expense, and I credit a salaries and wages payable account. Now remember, when I'm debiting the salaries and wages expense, this is what we call the general rule. But there can be exceptions to that. So if a question specifically indicates to you that there would be an exception, then in some cases we could be debiting inventory or debiting property, plant and equipment, for example. I want us to spend some time in detail looking at some of the other types of short-term paid absences. Most common ones, and the ones that we're going to focus on, are annual leave and sick leave. Now, in practical questions that you will be given, you have to read carefully the terms and conditions of the fictitious scenario that you're being given. But in Australia, annual leave employees generally are paid 20 days per year and sick leave 10 days per year. As I say, different questions for you might have slightly different numbers, but these are the general concepts in Australia. So before we look in detail at this annual leave and sick leave, there's some terminology that we need to be familiar with. When we talk about these short-term paid absences, there can be a number of different conditions or characteristics attaching to them. So if you look at the first box here at the top of the screen, short-term absences can be either what we call accumulating or non-accumulating. An accumulating absence is one whereby any unused leave can be carried forward to future periods. So if I am entitled to 20 days annual leave per year, but I only take 15 days, then if the leave is accumulating, it means I can carry forward the other 5 days until next year, for example. If, however, the leave is non-accumulating, then if I don't use the leave in the current year, I do not get an opportunity to carry it forward. So accumulating leave carries forward, non-accumulating leave does not carry forward. The second condition or characteristic that can apply to short-term absences is that the leave can be either vesting or non-vesting. If leave is vesting, it means that in the event that I resign to go and work somewhere else, any unpaid entitlements would be paid out to me when I leave the company. If, however, the leave is non-vesting, it means that if I have any amounts owing to me, but I decide to leave to go and work somewhere else, those unpaid amounts will not be paid to me. So if it's non-vesting, it means I can use it, but I can't actually get it paid out to me in a lump sum, for example. So we have a combination of different characteristics that can apply to different types of leave. And the accounting treatment is going to be different depending on what the characteristics are. So in order to work out the accounting treatment, the first question we ask ourselves is the leave accumulating? In other words, can any unused leave this year be carried forward to next year? If the answer to that question is no, then straight away I know that I am not going to recognise a liability for any unused leave. I am simply going to recognise an expense as the employee takes the leave, but I will not recognise a liability for anything to carry forward. If the leave is accumulating and therefore can be carried forward, I then need to know whether the leave is vesting or non-vesting. If the leave is accumulating and vesting, then I recognise a liability for the full amount of unused leave, because the employee will either be able to take that leave in the future, or they will be entitled to a payment for any unused leave on departure from the company. So if it's accumulating and vesting, then I recognise the full amount regardless of whether it's going to be taken in the future or not. If the leave is accumulating but is not vesting, then I am not going to recognise a liability for the full amount. The amount of the liability that I am going to recognise will only be for the amount of leave that I expect the employee will take. If I do not expect them to take the leave at some point in the future, then I will not recognise a liability. Annual leave, all annual leave is accumulating and vesting, which means that for annual leave, we always recognise a liability for the full entitlement. Sick leave is more complicated. Different jurisdictions, different countries, different states, different employment contracts can have different conditions. So sick leave can actually fall into any of the three light blue boxes here. Sometimes it's accumulating and vesting, sometimes it's accumulating and non-vesting, and sometimes it's non-accumulating. So let's start with looking at the treatment for the annual leave because it is consistent. And then we'll move on to looking at what happens with the three different characteristics or three different categories of sick leave. Before we look at some detailed examples, our pro forma journals. When we are recognising a liability for any unused leave, we debit the expense, annual leave or sick leave, depending on what type of leave it is. We debit the expense and we credit a provision. When the employee takes the leave, we debit the provision, we credit cash. Now remember, recognition as an expense is the general rule. There are some exceptions to that. So sometimes for the entry at the top, occasionally you might be debiting inventory or plant and equipment, for example. So the liability that we are recognising here is categorised as a provision. And remember that definition, that's provision because there's some uncertainty about the amount or the timing. We don't know exactly when the employees are going to take the leave. Sometimes we don't know exactly how much leave they're going to take. Okay, so I'd like you just to press pause, take a moment to have a read of the example here, and then we're going to work through it together. Okay, so we've given some information about an employee here. We've told his annual salary, and we're advised that he's paid on a weekly basis. We're also told that this employee, when he receives annual leave, that he is entitled to a leave loading. Now, under certain employment awards in Australia, sometimes employees are entitled to an additional payment when they take their holidays. That additional payment is referred to as a leave loading. So what this is telling us is it's telling us that when James takes his holidays, that in the weeks that he's on holidays, he gets paid an additional 17% on top of his normal salary. It's asking us to work out what the journal entry would be to record the annual leave, assuming this company accrues their leave on a weekly basis. Okay, so let's have a look at the workings, etc. His annual salary is $105,000, and he is entitled to 4 weeks leave per year out of a total of 52 weeks. He is also entitled to a 17% leave loading, so I multiply by 1.17. So the total amount of annual leave that he is entitled to per year, $9,450. If the company prepares weekly journal entries to record the leave, then it means the amount they are going to recognise every week when they prepare their annual leave journals, they will set aside $182 every week for James's leave. So each week they would have a journal entry, debit the annual leave expense, credit provision for annual leave. So this is the annual entitlement. This is the weekly entitlement. And if, for example, you were asked for the monthly entitlement, okay, so just read each question carefully. If you were asked for his annual entitlement, then it's simply the full 9450. If you were told they prepare journals on a monthly basis, then the amount that goes into the journal entry would be $787.50, for example. Now, what happens when the employees take their leave? So we've been asked to record the journal entry, assuming that James takes 3 weeks holiday. So we know what his annual entitlement is, 9450. So we divide that by 4 times by 3, and this gives us the total amount that he's going to be paid whilst he's on holidays. So when he takes his 3-week leave, he'll be paid a total of $7,088. We debit the provision and credit cash. Now just be careful, or not be careful, be aware, I should say. Even when James is on holidays, he will still be accruing leave. So every week that he is on holidays, they will also have to do the standard weekly entry for accruing the leave as well. So once you've got these entries down here, I want you to turn back for a moment to slide 26. Every week that James is at work, the company will prepare the entry on slide 26 plus the entry on slide 32. So every week he's at work, slide 26 and slide 32. When he actually takes his holidays, then he will do the the company will prepare the 2 entries on slide 33. All right, let's move on now and have a look at the sick leave. As we discussed earlier, the sick leave can have different conditions attached to it. So we've got to look at this one a little bit more carefully. So just take a moment to read the information here and then we're going to work through this scenario together. Okay, so it asks us at the bottom to determine what the expense for the year and the provision would be if the sick leave was non-accumulating. Based on our flowchart back on slide number 29, if the sick leave is non-accumulating, we do not recognise any liability, so no provision, and we will simply recognise an expense as the leave is taken. So the detail of the leave that has been taken is in the last bullet point here on slide 34. 40% used their full entitlement. In other words, 40% took 2 weeks per year. 25% took 1 week and 35% took none at all. And the other thing that we need is the fact that the annual payroll is 2.6 million. So 40% of employees took their full entitlement, which was 2 weeks. So the expense for the 40% that took a 2 week of leave is $40,000. 25% took 1 week and 35% took none. So the total expense that will be recognised is $52,500 and there is no liability because it is non-accumulating. It's now asked us to determine what the expense would be if the leave was accumulating and vesting, and also if it was accumulating and non-vesting. If the leave is accumulating and vesting, we recognise a liability for the full amount because the employee can either take the leave or they can have it paid out as a lump sum if they decide to resign. If it's accumulating but non-vesting, then we are going to recognise a liability only for the portion that we expect is going to be taken. So the best way to work this out is we work out what the expense will be for the full entitlement first. So whether the leave has been taken or not, the full amount is going to be recognised. So the formula here indicates that 100% of employees are entitled to 2 weeks per year. So the expense will be 100,000. We already know from our previous calculation, we already know that $52,500 worth of leave has been taken during the year, which means the provision, the amount that will carry forward into future years, therefore is 47,500. So the expense is 100, the provision is 47,500. The journal entries would look like this. The full amount will be initially recognised as an expense and corresponding provision, and as the leave is taken, we would have a second entry, debit, provision, credit, cash. So these are the summary journals for the year. Now, we already knew the 52,500 because we had calculated it earlier, but if we hadn't done the previous part of the calculation, here's an alternative way that you would have been able to calculate the provision in a more direct fashion if you needed to. Okay, now the third possibility is that the sick leave could be accumulating but non-vesting. In this case, the amount of the liability will only be for the amount of the leave that we think will be taken in the future. So just take a moment to have a careful read of the second bullet point here before we look at the calculations together. Okay, so our starting point to work out the total amount of the expense, our starting point is the leave that has already been taken, which we calculated earlier. Now the provision. So 60% of employees who did not use their full entitlement are expected to make use of 1 week in a future period. So 60% of employees are expected to use 1 week's leave. The opening balance in the provision account was 0. So the full amount of this will result in an increase in the provision. Just be careful here that this amount, the formula that we've done for the calculation here, this part of the calculation will give you the closing balance in the provision account. The amount that will be recognized as an expense is the current year movement. So if I already had an opening balance in the provision account, then the current year movement is the amount that the expense would increase by. Opening balance is 0. So the full 30,000 represents an increase in the provision, which means in this case the total expense is 82.5. So the closing balance in the provision account is 30,000, and the total expense for the year 82,500. All right, we're now going to, so before we move on, I should say there's quite a few practical examples of questions relating to both sick leave and annual leave in the in-class homework that we're going to do together and also in your self-study. So we'll move on now then to the long-term employee benefits, and we're going to be looking at long service leave here. Now this long service leave is a state-based leave entitlement in Australia. So different states in Australia have different requirements for long service leave, and other countries obviously have different requirements as well. So in New South Wales, for example, most employees will be entitled to 2 months long service leave after 10 years of continuous service, and then an additional 1 month for every 5 years after that. Many of the questions that you will be given, however, have differing requirements. So some questions might say that you get 13 weeks leave after 15 years service. Some might say 10 weeks leave after 12 years service. So just make sure you check every question carefully, because the inputs going into the formula can be different depending on the requirements of each question. So in terms of recognition and measurement, the recognition criteria for the long-term benefits is consistent with that of the short-term benefits. So we recognise a provision as the employee provides the service. However, when we measure the amount of the provision, we have to discount the nominal amount back to the present value, because these are amounts that may not be paid for 6, 7, 10 years' time, for example. So we firstly calculate the nominal value, then we discount it back to the present value. When we are performing our present value calculations, it's based on the expected payments that we anticipate that we are going to make in the future. So therefore, we base our calculations not on the employee's current salary, but what we think their salary is going to be when they take the leave. When we are applying our discount rate, we use the rate for high quality corporate bonds that match the timing of the cash flows. What this means, for example, is if I have an employee who is going to become entitled to take their long service leave in 5 years, then I need to find the yield on high quality corporate bonds that have a 5-year maturity date. If the employee is going to be entitled to take the leave in 3 years, then I use the 3-year bond rate as my discount rate. So you'll be given a whole list of different rates. You need to pick the correct one depending on how many years it is until the employee becomes entitled to take the leave. So I want you to take a couple of moments to have a look at the information here. And also on the next slide as well. So slide 40 and 41. So we have 5 employees here. They all have differing years of service. And the long service leave in this case is going to vest after 12 years. So once they've been employed for 12 years, they're entitled to take 10 weeks leave. So you can see, firstly, the number of years of service that each employee has served, and then how many years until their long service leave vests. We also have their current salaries and the probability that they're actually going to reach the requisite number of years of service. In addition, we have the various bond rates for differing maturity dates. So we've been asked to calculate what the amount of the provision for long service leave would be, and then to prepare the journal entry. So this is a reasonably complicated process here. There's a very detailed step-by-step process that you have to go through. So we're going to have a look in detail at the calculation for one of the employees on the list there. So if we just go back, we go to focus on the first employee on the list, Mike. So we're going to do this calculation together for Mike. And then you're going to take that concept and apply it as after you've finished watching the recording, you're going to apply it to the other four. So here is the relevant information for Mike. Mike has 2 years of service and 10 years until the long service leave vests. So corporate bond with a period to maturity of 10 years gives us the appropriate discount rate to incorporate into Mike's calculations. Right, so first thing we need to do is we need to calculate Mike's projected salary. So what we think Mike's salary will be when he becomes entitled to take the leave. So we saw that his current salary was $40,000. We can also see that the projected inflation rate is 2%. So if Mike is currently paid $40,000 and his salary increases by inflation each year, then in 10 years' time, when he becomes entitled to take the leave, his projected salary is $48,760. So you can see the calculation there, his current salary multiplied by 1.02, because the inflation rate is 2%, to the power of 10 years, because it is 10 years until he will be entitled to take the leave. The next thing I need to do is I need to work out how much long service leave benefit has been accumulated for him so far. So Mike has been employed for 2 years, and he needs to be there for 12 years in order to be entitled to be paid the leave. Once he reaches that 12 years, he will receive 10 weeks long service leave. So the formula to calculate his accumulated benefit, he's currently been employed for 2 years as a proportion of the 12. He will receive 10 weeks leave as a proportion of 52 weeks once he becomes entitled. And his projected salary that we just calculated in step A is $48,760. So his accumulated benefit is $1,563. I now need to calculate the present value of that accumulated benefit. The discount rate for the corporate bonds with a 10-year term is 8%. So the formula to calculate the present value is his accumulated benefit divided by 1.08 to the power of 10. Once I've determined the present value of Mike's obligation, I then need to determine the likelihood that he will actually remain employed for another 10 years and therefore receive the benefit. Back on slide number 40, it told us that the likelihood of him making that 12 years was 15%. So therefore, the amount that I'm going to recognise as the liability for him is 109. It's really important that you become familiar with this step-by-step process and that you can accurately perform these calculations. So what I want you to do when you finish listening to this lecture recording, I want you to do exactly the same process for the other 4 employees. I've given you here the answers, but I want you to make sure you can do these calculations accurately yourself. So here was Mike, and here are the amounts for our other 4 employees, which means the total amount of the long service leave liability for this company is 16,314. If the opening balance in the provision account was 12,500, then our journal entry is for the movement during the year. The current year movement is 3814, and therefore our journal entry to recognise the current year expense would be this one. All right, so before attending the online face-to-face session in week 2, what I would like you to do is to make sure that you have done the readings for topic 1 and 2, and you have done at a minimum the in-class homework questions for topics 1 and 2. Because in week 2 classes, we are going to be firstly doing a review of the topic 1 in-class homework. We will do a quick recap of the topic 2 online recordings, and then we will go through the topic 2 in-class homework questions in detail. The self-study ones you can leave and use as study throughout the term if you'd like, but at a minimum, please make sure you have attempted all the in-class homework questions for topics 1 and 2. Okay, I look forward to seeing you all in class in week 2. Bye for now.